Most traders think they lose because their strategy isn't good enough. But the truth is, you could have the best strategy in the world, and still blow your account, if your risk management is wrong. Today, I'm going to teach you the exact risk management rules professional traders follow to stay in the game, protect their capital, and grow consistently. And stick around, because at the end, I'll share my personal formula for calculating the perfect lot size on a trade. Welcome to BigPips Trading Solutions, where we cut through the noise and give you practical forex strategies that actually work. This is episode 2 of our forex educational series. In episode 1, we covered the basics of forex, what it is, how it works, and why most beginners fail. If you missed that, go watch it first, then come back here. But if you're ready to protect your account and start thinking like a professional, let's get into risk management. What is risk management? Risk management is simple, it's the process of protecting your account from blowing up. Most beginners think trading is about finding the right entry. But the truth? Trading is about staying alive long enough to let your edge play out. Here's a rule you'll hear me repeat over and over. Right arrow risk only 1 to 2% of your account on a single trade. That means if your account is $1,000, the maximum you should risk is $10 to $20 per trade. Not $100. Not half your account. Just $10 to $20. It sounds small, but here's the math. Risking 2% means you can take 20 to 30 trades, even if half are losses, without wiping out. Risking 20 to 30% per trade means 3 bad trades can destroy your account. Stop loss placement. Here's the second golden rule, always use a stop loss. A stop loss is your safety net. It closes your trade automatically when price goes against you. Without it, you're gambling. But here's the mistake most traders make, they place stops randomly. Too close, and you get stopped out by noise. Too far, and your risk is huge. So here's the smart way, place your stop loss beyond structure. If you're buying at support, put your stop just below the support level. If you're selling at resistance, put it just above the resistance level. That way, you're not stopped out by random market movement, only when your trade idea is invalid. Risk-to-reward ratio. Next up, risk-to-reward ratio. This is the secret sauce of consistent trading. Always aim for at least 1 to 2. That means if you risk $10, you're targeting $20 profit. Here's why this matters. Even if you win only 40% of trades, at 1:2 risk-to-reward, you'll still be profitable. But if you're trading 1-to-1 or worse, you need a much higher win rate to survive. Write this down, you don't need to win every trade. You just need to let your winners be bigger than your losers. Position sizing formula. Now let's talk about position sizing, the most overlooked part of risk management. Here's my personal formula. Position size equals account balance x risk percent divided by stop loss in pips x pip value. Don't worry, I'll break it down with an example. Account balance, $1,000. Risk, 2%, $20. Stop loss, 50 pips. Pip value, €4 to US dollar, 0.10 lot equals $1 per pip. So, $20 divided by 50 pips x $1 equals 0.04 lots. That means the correct position size is 0.04 lots, not a random 0.10 or 0.50. Backhand index pointing right pro tip, many brokers have free position size calculators. Use them until this formula becomes second nature. Psychology of risk. Now let's talk mindset, because risk management isn't just numbers, it's psychology. Here's the trap, greed and fear. Greed makes you risk too much to get rich quick. Fear makes you move stops or close winners too early. Professional traders think differently. They accept losses as part of the game. They know that one loss doesn't matter when the math is in their favor. Remember this, your job is not to win every trade. Your job is to protect capital and execute your edge consistently. Let's recap episode 2. Risk only 1 to 2% per trade. Place stops beyond structure, never at random. Always aim for at least 1 to 2 risk to reward. Calculate position size correctly. And most importantly, control your emotions. If this breakdown helped you, hit that like button and subscribe. In episode 3, we'll cover support and resistance made simple, how to spot the exact levels where banks and big traders enter the market.